Hello, so this video is going to be a little bit difficult one. Uh, I want to talk about my investment mistakes I did in value investing so far, and those are not going to be just sporadic mistakes I did once in a while. I feel like I pretty much failed with value investing so far. I mean, I'm still holding on to my position, so we'll see how it ends long term. But so far, I do feel that I did poorly. I'm gonna talk about it in a minute, but yeah, what I did previously was a few videos about positions I was holding. I'm still, I mean, except Alteryx that was bought out, I'm still holding them where I'm deep in the red. And I really try to see if there is a pattern and if there is something wrong that I did, or is it just the market right now. And I really wanted to understand why am I doing so poorly while there is a bull market and the market is going up. So, and then I had some kind of an identity crisis a little bit with value investing. And this video is going to be the first part of a series where I lay the groundwork. Already spoiler alert for nobody's watching it, but anyway, for a kind of a strategy shift that I'm doing right now that I feel that is not really working for me so well what I did so far. So in this video I really want to talk about the value investments I did do so far, and how they did not work well, and why is that. And I'm going to talk about specifically, I mean, there were many mistakes done, but specifically I guess the four biggest factors that contributed to my poor performance with it. So I've been investing for about 5-6 years right now, but I really started from like efficient market theory and passive investing, ETFs, bonds, and all that, like 60%, 40%, and then slowly but surely I kind of got diverted from it, where I kind of stopped believing the core assumptions that are laid into the efficient market theory and passive investing. Never mind, not the point, but I got really into active investing about 4 years ago, where I started to really learn a lot and study a lot and read all the books and absorb a lot of information. And I started with a little bit of smaller bets, and then I really placed my highest conviction of highest positions. It was 2021, so it was 3 years ago, and we're gonna see the list of the positions in a minute, but they did really poorly. So I can say that overall my portfolio over those like 4 or 5 years is pretty much break even when the market soared. So obviously a major loss for me. But it's break even because my value positions really did poorly. I mean, really poorly. I mean, I'm talking 50% down until 90% down, 90% down, while other positions I made and I played around with it did well. So taking all that, and the value positions were my biggest ones because I really had high conviction in them, and I placed smaller positions in different strategies. So overall, I'm kind of break even, but I do want to focus on the value part of it. So if I look at my list of my biggest conviction value plays. It's an oddball. For anyone that is not familiar, I mean there are really small cap stocks here also. So I'm not going to go into too much detail about each company. So Goose is Canada Goose. It's the Canadian down jackets brand. Solar Edge with the solar solution, the solar inverter whole solution for residential and commercial segments. Malibu Boats, which is a recreational boats in the United States. Med, which is a Medifest, which I'm not going to be proud of all those stocks because of how they did, but it could have gone the other way around also. But yeah, it's one of my more shameful picks. So Medifest, the Optavia brand of dietetic food, where you sign up for this program. I don't want to talk about it too long, but it's like it has a little bit of a shady model of it's like a multi-level marketing, but not exactly. But I'm gonna talk in a second why I picked those. But yeah, it went really poorly. I'm like down more than 90% on it. I think it just exploded. So Baba, Alibaba, Alteryx, which already was bought by private equity, but I was really down on it. And there's nothing I can do. I cannot wait for it any longer. It was just bought out, and the Expel is a auto parts company, which I was contemplating whether to include it even because it was my earlier bet, like really early, and it was a small bet, and this did really well. So just. Yeah, but it was a small bet. So my biggest bets did really poorly, all of them. I did not include my cost basis, but I can say that on all of them I'm down between more than 50%, between 50% and 90%. So yeah, so this really seems like an oddball of picks for me now also, because I mean, is this even value investing? Those are not typical value stocks. I mean, maybe except for Alibaba, where they have, like a big asset base and, like a history of profitability and steady cash flows and all the things you would expect maybe in value stocks. So maybe I haven't included that, but maybe that's also like a mistake I did. Yeah, really not classical values picks, but what did I see in them? And again, I guess I was wrong, so do not take from me. But overall, all those companies, they were profitable, except maybe Alteryx, but Alteryx had really high gross profit margins, like over 90%. So I think, and it was really, of course, it's a software very asset light. I mean, there are practically no assets, like hard assets. So it was really a company that was not requiring a lot of investment, and it was really highly profitable gross profit. So I was imagining that when it did focus on profitability and when it did scale, it would get to high. I mean, its earnings power seemed really high to me. So that's Alteryx. But all the rest of them, like Canada Goose, SolarEdge, Malibu Boats, Medifest, Alibaba, and Expel, they're all profitable companies with, at the time, they had a really high return on invested capital, and this is, of course, one of the major criteria to look at. So they all had strong brands, and I'm gonna talk a little bit in this video, and I'm contemplating already to just do a separate long video about this issue and this topic. But they did have a strong brand, which seemed like a strong moat also, where maybe they are operating. I'm gonna talk about it. This is one of the mistakes I'm gonna talk about, but I'm already gonna say that they are operating in highly competitive environments, but they do have their own brand, which seems like it has a following, and people do like it and admire it, and they have their own market share, and it's not like a generic product. I mean, there is the brand there, and so that's true for all those companies also. They all were like healthy business model, healthy organic growth, when they don't need to do like shady M&A and to get into like different sectors and different businesses just to show growth. I mean, they were growing healthily, maybe too much for value pick, but I mean, maybe that was the pitfall I fell for, but because they were some of them were growing really in a high rate at the moment. But what I want to stress here, that the growth was organic, it was healthy, it was coming from the real expansion of the business. Most of them were growing internationally and expanding into new international markets. So it looks like a really, again, like organic, healthy growth. They all had low debt. Some of them no debt, like Medifest. So yeah, the management of most of the companies is even where you have the founder, CEO, or like if I go back to for Goose. The current CEO is the grandson of the founder. For SolarEdge, the CEO, the CFO, they might shift now with all the explosion that is going on there, but they were there from the start. I mean, the main founder has unfortunately passed away, but they were really the people that were surrounding him from the start. Malibu Boats and Medifest, they're not the founders, but they have a really big experience already in the company. They're the management that is there for a long time, and it managed to grow the company really well during this time, and they seem like really shareholder focused for me at the time, shareholder focused, and like really long-term focused also, and not like this only professional hired management, but really it seemed to me like they do have the skin in the game. So yeah, Bob, of course, with Jack Ma, although I think I invested already after he was outed from the company, but I think it's obvious until now that he does still pull strings in the company, and he does have his certain control of things around Alibaba. Even from wherever he is. So yeah, so Alteryx is different. It's an exception here. It did have a complete change in management, and I talked about it in the video I did about it, that I didn't really like the management that well. Yeah, and Expel, I don't even remember, but yeah, so that's the management. And all those companies, for me, like one of the biggest questions I was asking myself when I placed a big bet in a company was, can I rely on this company long term? Like, if they close the market now for 10, 20 years, do I believe this company was still gonna be there? And will it grow? Will it be like a solid business? Like if it was my family business, the one business that my family depended on, can I trust it? And the answer for all those companies for me was yes. Maybe I'm naive. Maybe that was a mistake. I don't know. But again, if I look at them, they're like all like this company that I felt that I can trust long term. So again, maybe I was wrong. And of course the price. So we're talking about value investing here. They were all undervalued at the time. I mean, for what I thought the fair value was, and of course now I look back and I do think with the current circumstances that I overpaid for a lot of them. But at the time, with the growth they did, and I wasn't counting on like huge 100% growth. I mean, even with moderate growth, if they did continue with moderate growth, which they did not, all of them did not, but even with like 13% growth, I mean, which was modest for them at the point that I invested, they would have done well. The price at the moment that I bought did not take this growth even into account, and maybe the market was forward looking and it knew something that I did not. But yeah, so again, those are kind of growth companies, all of them, maybe except Alibaba, but that's what I'm saying. That's not really classical value investing, and it gets me to the whole debate of growth versus value, which I don't really want to get into now, but again, taking into account moderate growth, I think they were undervalued. I bought them at the time when they were already off their all-time highs, when there was some kind of disappointment in the market, in all of them. Even in SolarEdge, where I bought after it fell already from 360 to 220, which I thought it was low at the moment. I mean, I thought, wow, the market is overreacting to some news right now, and it's gonna go to 700 even in the next few years. So yeah, obviously things did not work out this way, but so yeah. So those were my reasons, but obviously it did not go well at all. And after analyzing most of them, I tried to like find the path. I mean, I could talk separately about each company. I pretty much did, but about my investment mistakes with each company separately, and it's gonna be nuanced, of course, and a little bit different for each. But or if I need to find like a pattern, where did I go wrong with my mindset, with my approach, with my strategy? So it all comes down. I think I kind of narrowed it down to 4 biggest mistakes that I did. So the first one is the most big one, and that's, I think, the major one, the one that disturbs me the most. I want to do a separate video on, so that's going to be my next video, because it's just such a huge topic and I want to really devote it as a separate conversation to it. But I'm gonna just say like the top level, and I really want to deep dive into this issue in my next video. So for me, I didn't have a lot of time at the time to research a lot of stocks, and every stock, because it's value investing, I mean, I was reading the annual reports, I was listening to all the earnings calls, I was looking for interviews with the management online, I was reading what customers were saying, what employees were saying, and it took a lot of time. And that's all good. I mean, that's what value investing is supposed to be. I'm sure there are people who research even more than me. But for me, I didn't have so much spare time. I mean, I did not devote so much spare time, and I couldn't really. So what happened for me, that I researched only a handful of stocks, and then those handful were the only ones that were really my target stocks. So something in me really wanted already to invest in them, and I think in my mind, I don't want to get, again, I could talk about this for hours, but something in me really even discounted the fair, discounted the other way around, increased the fair value just so I could meet it. I would negotiate with myself about the price that I would be willing to pay for it. And I think, like I talked in the video about SolarEdge, that I chose to ignore a few issues and a few big issues. I mean, I think if I would have been really honest with myself, I would realize that SolarEdge might be uninvestable even, but somehow I convinced myself to place that bet, because I just had no other options at the moment. Again, I want to talk about it separately, but I think that was my biggest pitfall I felt too, because again, I just had some little stocks, target stocks, that I kind of told myself all the narratives I need to invest in them. So yeah, I think that's gonna be like the basis for really a strategy shift that I'm gonna try from now on. But that's the reason number one, and if anyone is watching it, stay tuned for the next video when I really want to talk about it more extensively. So that's the first reason. The second reason, and also I could talk about it, but I'm gonna talk about it a little bit extensively now. That's the cyclicality of the business. So of course, all the businesses I invested in were in consumer cyclical sectors, but they're really cyclical stocks, and in really cyclical businesses where it's fashion, it's the solar industry, it's a retailer like Alibaba, it's Malibu boats, I mean, of course, it's super discretionary. And even a company like Alteryx, which is technology and software, I talked about in the video that it's super discretionary in the IT industry, because that's gonna be the last thing companies would invest in when they're having to tighten their budgets. So they're super discretionary companies, and it's not that I didn't know that when I invested in them. So what was I thinking? At the time, my mindset, I knew there were cyclical stocks. I even have in my portfolio spreadsheet, I even have a column where I put like the sector, and I knew that all my biggest bets were consumer cyclicals. But for me, what I was thinking at the moment, that I don't know, I don't want to time the market. And I knew that if there's going to be a downturn in the market, in like a recession, that all those companies would suffer. But for me, if I'm in it for the long term, well, I don't know where that's going to happen. And for me, I can invest in them right now. If they go down because of a recession, I buy more. And then I'm gonna wait until we go out of the recession, because even if I hold the S&P 500, I'm gonna go down with the recession. So it's gonna, and I know, of course, cyclical companies are gonna go down a lot more. But okay, I can live with that. I can live with that. I can live with my portfolio going down 80% even. That's why I'm invested 100% in stocks. And if I know that I have like the light in the end of the tunnel, that in the next few years it's going to recover. So that didn't scare me so much, the volatility of it. But so that was my mindset. And again, at the same time, the advantages were that those are really simple businesses that I understand. I mean, much more than, I don't know, even food companies or insurance companies, banks, or those are really, I mean, company that produces and sells jackets. I mean, I can understand it really well as a beginner investor, and their reports were really simple. Everything was really simple to understand. Yeah, but now that I have experienced it on my own flesh, I see things a little bit differently, and I understand that everything is not that simple. And the problem is, it's all true. It's true that it's cyclical, so it's going down because of some external factors, or whether it's cyclicality in the industry or cyclicality overall in the market, and you can know for yourself that the company is long term is still okay, and that's all true. I mean, I still feel that. I don't know about SolarEdge, again, maybe uninvestable, but I still feel that about Malibu Boats and Canada Goose and Alibaba, and Medifest is like the fundamentals completely changed. It completely exploded. Haven't even researched it really, but you know, that's bound to happen. But with Medifest, it's not only cyclicality, but if it was, I was okay with that also. But the problem is how long does it take? And it is significant, because if you invested in, and after 2 years it only began the down cycle, and now it's gonna take years and years and years until it's gonna recover, because it's gonna be, you know, we're not in a recession yet, and there might come a recession now where those companies are gonna suffer even more, and then it's gonna take a really long while. We don't know. I mean, it could recover really quickly, or it could take a few years more. And then if I'm gonna only break even on those companies in like 7, 8, 10 years, yeah, long term they're probably good businesses. I mean, maybe not. Maybe yeah, they are. But this time is really significant, more than I thought. And of course, there's not only the possibility that I will need this money in the meanwhile, and I have to sell at a loss because I'm gonna need this money. I mean, this is the risk also, but also of course the opportunity cost, because if I would have invested not in cyclical stocks, I would have probably done much better now. So it really comes, and that if for who studied value investing, that might sound really obvious, but I do feel like there is some kind of a contradictory narrative here, and I want to talk about Peter Lynch and his book One Up the Wall Street. That, yeah, of course he says that in the book, that I mean, the common Peter Lynch wisdom about cyclical stocks is that you should not touch them until they go down, until there is blood in the streets, and then you begin to see a little bit of recovery, and that's the point where you should invest, because that's the time before that could take years, and that's exactly what I'm experiencing and talking about right now. But at the same time, I feel that in the same book, I mean, there is all this, and I don't want to criticize, I'm no one to criticize Peter Lynch. I'm just trying to make sense of the messaging, where, they say about Peter Lynch, there wasn't a stock he didn't like, that he liked so many stocks, and he was talking about like investing in what you see with your eyes and what you like and what the people around you like. And he had that example where he went to the mall with his wife and daughters, I think. I don't remember, I read it a long time ago, but and there was this fashion brand when it was so succeeding, like there were lines to the stores, and he was like, the messaging was like, it's an obvious bet when you see that, and I think this messaging is a little bit oversimplistic, because yes, it might be a good brand, of course, it might be a fad also, which is kind of ignored in this messaging, but let's put that aside. But even if it is a good brand that is really has something going for it, where people are going crazy for it, and it's not a fad, let's say, still it's so important to know your time in the market. And I don't want to say you need to time the market, and here I really respect, I think one of the best books about value investing is The Most Important Things, Howard Marks, and I think he nails this point really well, when you shouldn't time the market, because you can't, but you really need to know where you are in the market cycle and to which time in the market you are right now. And it's not that I didn't know. I'm going to talk in a minute how I did miss a little bit on understanding the timing in the market, but you should really understand, especially, of course, with cyclical stocks. It sounds so obvious, but I do think there is some contradictory messaging around it. So I really learned it the hard way. I will, from now on, really be mindful when I'm investing in cyclical stocks, even if it looks, I think what I will do is like stay away even from a really fast-growing cyclical stock until there is blood in the streets. And I think at the moment where I invested like in Canada Goose and in Medifest and in SolarEdge and in Malibu Boats, I thought it was already blood in the streets, but it was not. It was just the beginning of it. So, well, yeah, you cannot time the market, but I'm hoping my point about the cyclicality and how it's a little bit confusing. I think there is some oversimplification of this topic in the teachings of value investing. So yeah, I hope I drove this point home. I'm not sure. Well, that's what there is. Reason number 3, my mistake number 3 with value investing is the issue of the moat, and I briefly mentioned it before. What is a moat and what is considered a moat? And of course, you can find countless writings and even videos on YouTube of Warren Buffett explaining what exactly is a moat and which forms does it take, in the form of entry barriers, of like regulation, you have the brand, or you have like the really high costs of entry barriers, or the brand. So a brand is considered like a moat, but every company has a brand. So is every brand a moat? No, it's not. And most companies operate in highly competitive environments. So when I look at my investments, I think they all have a nice brand moat. They still do, but there is such a huge risk with the moat when it could eradicate in a minute. I mean, all of them. I could talk about the nuances of each industry, where for SolarEdge it's like technological, and once if it doesn't stay in the spearhead of technology, it will lose its mode. Or I can talk about Canada Goose, where it's fashion, and if it doesn't stay in the, I don't know, trendy and fashionable, and will be able to maintain its like status of luxury and high end, and like celebrities that are wearing it everywhere, so it's gonna lose its mode. And then I can talk about like that about Medifest, where with Medifest I thought it was really strong. I still think it had a really strong mode when it had this network of coaches. I forgot the word. Of coaches. So this whole network, this whole model, it was a really huge asset they built, and I think it's not easily replicated. And plus you have the brand and the products they developed, which do work, and they work well. Again, you can like or you can dislike this approach in dieting or losing weight, but anyway, I'm diverging, but what I was going to say, that Medifest also has its mode, I think, had at least before it completely exploded, but it all can change in a minute, and it changed in a minute. So where are all these coaches now? They're just running away. So yeah, company can have a moat, of course. Maybe if it's a moat like entry barriers, when it's a highly regulatory environment, I don't know, like a mobile service provider, when you cannot just become a mobile service provider within a day. So maybe it's a better moat, but I don't know, the issue of a brand as a moat is really problematic also, I think. So take whatever you take from it. So I think that was also, I kind of overestimated, although there's nothing surprising for me here. I mean, I knew that SolarEdge could lose its edge. Pun is not intended, but it's done in a minute. And Canada Goose, of course, it is fashion. Nothing surprising here. I mean, I knew that, but I can really feel the fear now that that I'm holding on to them, waiting for them to go out of this down cycle. But will they be able to hold on to their moat when they're 5 years from now, 7 years from now? So even in 1 year from now, you know what, if it was 7 years from now, fine. But even 1 year from now, is Canada Goose, now they're really having a bad time. So maybe they're losing their moat, who knows? I mean, you live with that fear. I don't sleep well with it at night, with the moat thing specifically also. So that's reason number 3. And reason number 4, well, there's nothing much we can do about it now, and it's really specific, so that's why I kind of saved it for the last, and I'm not going to talk too extensively about it, because it was really specific for the time. I guess we could learn something from it, but I kind of placed all those positions in 2021 when I really did, I really invested more time in researching stocks, and I felt like I'm on a roll, and I kind of got, I felt like I get it more, and I can place bigger bets now, and I researched a lot of stocks, and those are the ones that really caught me. So never mind, I placed all those bets in 2021, and it was a poor year, especially for cyclical stocks, to invest, because of everything that came after COVID, or is it okay to say? Okay, I hope. Where you had the stimulus checks, and the stimulus to everyone, to companies and to individuals in all countries, and everybody had too much money to spend, and they went and they bought their Malibu boats, they bought their Canada Goose jackets, and they had a lot of money for expensive Octavia foods from Medifest, and that's the time where they really showed high growth because of that. And I knew that this high growth might not be so sustainable for most companies. Some of them, like SolarEdge, were even saying that themselves. but I still did not realize how much of a pullback is gonna come after this effect is gone. Yeah, I kind of was burned by that. So that's exactly what happened. They just enjoyed the boom in 2021, and then it's not only that. I mean, each one of them were also experiencing serious secular headwinds, but also the pullback from the boom, the bust that comes after the boom of the stimulus checks in 2021. Really, I got really burned by that. Yeah, those are the big mistakes. And again, I think my biggest one was the first one, and I am gonna make a separate video about it. I want to talk about it again, mostly for myself. I really need to make a point to not fall to this pitfall again in the future. So yeah, overall I think I did pretty poorly, obviously, and that's a learning experience. I mean, I am in it for the really long term. I love investing. I love researching companies. I'm gonna, again, one of my next videos is gonna be about the nature of how you do value investing and how that where it fits me and where it might fit me less. But yeah, I feel like I've made some really serious mistakes, which for one, I can just make a point to not do them in the future. But I think I will make some strategy shifts. I mean, I know I will. I already started to make a strategy shift, which I'll talk about it again in the next video. So if anyone is watching it, thank you, really thank you. It's really, even one watcher is really a lot. It's cool. Yeah, so stay tuned if you do. Stay tuned for the next videos where I'm gonna continue to build up from those thoughts into a kind of a, I mean, I'm still a value investor, but a kind of a strategy shift. So yeah, so bye bye.